Welcome back to All About Economics. In the last two episodes, we priced ordinary bonds and learned that the coupon rate is not the same as your real return. Today, we add the two wrinkles that bite hardest in the real world: inflation and taxes. We will meet the index-linked bond, designed to protect your money from inflation, and we will follow the money through the taxman's hands and the quirks of how principal is repaid to find what an investor actually keeps. A bond sticker rate is just a clue. The truth is always a different number. Let us become financial detectives and follow the money. Section 1. The problem with fixed bonds. Recall the danger of inflation from our macro episodes. An ordinary bond promises fixed payments, a fixed coupon, and a fixed principal. But if inflation rises, those fixed shekels buy less and less over the bond's life. You might earn a 4% coupon while inflation runs at 5%, quietly losing purchasing power every year. For long-term savers, pension funds, and anyone parking money for decades, this inflation risk is serious. So governments created a clever solution, a bond whose payments automatically grow with inflation, protecting the investor's real purchasing power. That is the index-linked bond, and it is one of the most important instruments in any modern bond market. In Israel, a large share of government debt has historically been index-linked, a direct legacy of the high inflation era we studied in Part A, when no saver would lend long-term in shekels without protection. The United States issues them too, known as TIPS, or Treasury Inflation-Protected Securities. Wherever inflation has frightened savers, these bonds have flourished. Section 2. How indexation works. The mechanism is elegant. An index-linked bond is tied to a price index, usually the Consumer Price Index, the CPI. When the bond is issued, the current CPI is recorded as the base, say a value of 145. From then on, every payment the bond makes, both the coupons and the final principal, is scaled up by the ratio of the current CPI to that base CPI. So if prices rise 10% over some period, the CPI ratio is 1.1, and your payment is multiplied by 1.1. The bond literally inflates its payouts in step with inflation. Your real return is protected because as prices climb, so do your coupons and your principal, exactly keeping pace. Section 3. Gross versus net coupon. Now the first reality check: taxes. The coupon a bond advertises is the gross coupon, the headline rate before the tax man takes his cut. Suppose a bond pays a gross coupon of 4.2%, but there is a 25% tax on that interest. What actually lands in your account is the net coupon. Take the 4.2%, subtract the 25% tax, and you are left with about 3.15%. That is the money that truly hits your bank account. This distinction between the gross promise and the net reality is the bedrock of honest bond analysis. Always work with the net, after-tax cash flows, because those are the only ones you actually get to spend. Section 4. Pricing an index-linked bond. So how do you price one of these inflation-protected bonds? The logic is the same present value machine as always, just with the indexation layered on. For each future payment, you take the base coupon or principal, scale it up by the expected CPI ratio to reflect inflation, then subtract the tax, and finally discount that net, inflation-adjusted amount back to today. Sum all those present values, and you have the price. It sounds like a lot, but it is just our familiar recipe with 2 extra steps per payment: adjust for inflation, adjust for tax, then discount. The beauty is that the framework never changes. Whatever the wrinkle, a bond's value is always the present value of the cash you will actually pocket. This is why a bond that looks intimidating on the page is rarely complicated in concept. Strip away the jargon, and you are always doing the same 3 things: projecting the cash you will receive, adjusting it for reality, and discounting it home to today. Section 5. The taxation wrinkle. Taxation deserves a closer look because it can be subtle. In the simplest case, tax applies to the coupon interest, as in our 4.2% example. But systems vary. Some tax the inflation-linked gains on the principal too, while others, recognizing that inflation is not real income, exempt them. Some tax capital gains if you bought at a discount and the price rises toward face value. The details depend on the country and the bond, but the principle for the investor is universal. Map out every shekel the bond will pay, apply the correct tax to each piece, and only then judge the bond. Two bonds with identical headline coupons can deliver very different after-tax returns once the tax rules are applied. Section 6. Amortizing bonds. Here is another wrinkle that changes everything: how the principal comes back. We have assumed the principal is repaid all at once at maturity, a bullet bond. But many bonds are amortizing, meaning they return a chunk of your principal every single year, alongside the coupon, rather than in one lump at the end. This matters for two reasons. First, you get your money back sooner, which, by the time value of money, is more valuable. Second, because the outstanding principal shrinks each year, the coupon, calculated on that shrinking balance, also falls over time. So the cash flows of an amortizing bond have a completely different shape, larger and front-loaded early, tapering later. You must map each year individually. Section 7. Following the money. Let us put on the detective hat with a concrete case. A bond has a face value of 100, but you buy it at 96.5, so at a discount. It pays a 4% coupon, and it amortizes, returning principal in chunks over 4 years. To find what you really earn, you follow the money step by step. For each year, calculate the coupon on the remaining principal, add the principal repaid that year, then subtract the tax due. That gives the net cash flow you actually receive each year. Lay all 4 years out in a row, and remember you only paid 96.5 for this stream. Now you can see the true picture, not the 4% sticker, but the real schedule of money landing in your pocket. Section 8. The real after-tax return. The final step answers the only question that matters: what return did the investor really earn? You take that stream of net, after-tax cash flows you just mapped, and you find the single discount rate that makes their present value equal to the 96.5 you actually paid. That rate is the bond's true after-tax yield to maturity, the honest annualized return on your money. And it will almost never equal the 4% coupon on the label. The discount you bought it pushes it up, the taxes push it down, the amortization reshapes it, and inflation, if it is an index-linked bond, protects it. The sticker rate was just a clue. This after-tax yield is the truth. And notice the humbling implication. A bond advertised at 4% might really yield 3 or 5, depending on these details, which means anyone who compares bonds by their coupons alone is comparing illusions. The professionals compare after-tax yields, and now so can you. Conclusion. We have followed the money to the truth. Index-linked bonds protect your purchasing power by scaling every payment with the consumer price index, so inflation cannot erode your real return. But taxes turn a gross coupon into a smaller net one. Amortizing bonds hand back principal in shrinking chunks rather than one lump, and the price you actually paid reshapes everything. The honest measure of a bond is its after-tax yield to maturity, the rate that equates the net cash you truly receive to the price you truly paid, and it is almost never the number on the label. Carry this detective's discipline into every investment. Next, we look at corporate and convertible bonds and the yields they offer. If this revealed the truth behind the sticker, please subscribe to All About Economics and share it. See you there.